Welcome back, everyone. We've got a brand new explainer for you right here on the Gap Advisors Ind AS Clinic YouTube channel. I'm absolutely thrilled you're tuning in today because we're going to unpack a classic year-end revenue recognition dilemma. You know, the kind that literally trips up finance teams all the time. Now, before we really jump in, just a very quick but important note. The views expressed in this explainer are entirely the personal views of the author, so they're not binding. We always request that you seek out the help of a professional expert before you take any action or, refrain from taking any action based on the views we discuss here today. All right, let's get into it.
So here's our roadmap for today. Number 1, we'll look at the year-end dilemma itself. 2, we'll dive into the Ind AS 115 framework. 3, we'll go over the resolution and its actual impact. And 4, we'll wrap up with some info on the Gap Advisors community.
Okay, let's dive right into this. Part 1, the year-end dilemma. Machines are sold, but they're not quite installed yet.
So here are the really fascinating facts of our specific case. We're looking at a company that manufactures capital goods. Think big, large-scale machines. Now, almost always, when this company sells a machine, they're the ones who also install it. And what's super interesting about this setup is that the installation charge, well, it isn't priced separately on the invoice at all. It just looks like one big seamless package. However, and this is a really big however, in some cases, a customer will actually issue a purchase order that clearly specifies that they, the customer, are going to handle the installation themselves.
So the business is humming along, right? But the clock is ticking. As we know, the reporting period runs from the 1st of April right up to the 31st of March. And as we hit that absolutely crucial March 31st cutoff, well, we've got a bit of a situation. There are machines literally sitting on the client's floor that have been officially sold, but the installation? That part is still pending.
And this brings us to the ultimate auditor's cliffhanger. Do we recognize all of that revenue right now as a single combined obligation? Or should the installation be treated as an entirely distinct transaction? Because think about it. If it is distinct, we're looking at a mandatory reversal of revenue for those unperformed installation services at year-end.
Well, to figure this out, we've got to consult the rulebook. Section 2, the Ind AS 115 framework, specifically focusing on identifying distinct promises.
Let's read the foundational text right from the standard itself. Paragraph 27 of Ind AS 115 states, "A good or service that is promised to a customer is distinct if both of the following criteria are met." So this is our absolute baseline. We have to test our machine and our installation scenario against this rather rigorous two-part test.
Let's break down how this translates into 2 highly actionable steps. Step 1, is it capable of being distinct? Meaning, can the customer actually benefit from the good or service completely on its own, or maybe with other readily available resources? Then, step 2, is it distinct within the context of the contract? Or simply put, is the entity's promise to transfer the good or service separately identifiable from the other promises? Remember, for it to be distinct, both of these steps must be met.
And this brilliantly illustrates how we judge that really tricky second step. Paragraph 29 actually gives us the exact indicators to check if the promise is separately identified. So we have to ask the client, are you providing a significant service of integrating the goods into one combined output? Does the service significantly modify or customize the other good? Or is the good highly dependent on or highly interrelated with the other promised services? These questions are absolutely critical. Why? Because if there's a transformative relationship there, you've just got one giant performance obligation. But if not, well, you have to separate them.
Now, when we apply that logic to our specific facts, the answer becomes incredibly clear. The customer actually has the option to install the machine on their own. And we know this for a fact because sometimes they literally submit purchase orders to do exactly that. So this proves there is absolutely no transformative relationship between the sale of the machine and the installation of that machine. They are just not highly interrelated.
Which brings us to Section 3, the resolution and impact, resulting in 2 separate performance obligations.
Because both of those conditions from paragraph 27 are firmly met, we have to identify these as entirely separate performance obligations within the contract. Obligation 1, that's the sale of the machine. Obligation 2, the installation service.
So the absolutely crucial point here is this. The company simply cannot just lump everything together and recognize all the revenue up front on the 31st of March. According to the standard, they shall recognize revenue for the installation service only as and when it actually completes the installation of those capital goods. If they ignore this,
They risk significantly overstating their year-end revenue and honestly inviting some pretty serious audit qualifications. And the financial impact of this on our March 31st financials is pretty stark. The company must reverse the Indian rupee revenue related to the installation charges for literally any of those contracts where the installation service isn't complete yet. You simply cannot count those Indian rupees as earned until the actual work is done. Finally, let's look at Section 4, the GAAP Advisors Community, and some amazing tools for auditors and finance teams. You know, the really fascinating issue and detailed response we just walked through today? It comes directly from the issue repository on gapadvisors.com. This is an incredible platform that currently hosts over 4,500 issues and their full responses regarding Indian accounting standards and Indian GAAP. And honestly, here is the best part. Any person can register for completely free on gapadvisors.com. Once you're registered, you can submit your own specific issues on Ind AS and Indian GAAP, and you'll receive a detailed, comprehensive response delivered directly to your email inbox. This is particularly huge for auditors who really need that concrete documentation to show exactly how they addressed complex issues relating to the application of Ind AS. Furthermore, this explainer actually discusses an issue that was featured in the latest 232nd edition of the GAAP Advisors Task Weekly newsletter. This is authored by C.A. Manish Siyer, who is the director of GAAP Advisors, and it's published right there on LinkedIn. To date, 232 editions of this fantastic weekly newsletter have been published. So if you're registered on LinkedIn, I highly encourage you to go subscribe to the newsletter for free. Also, if you want to explore this particular topic even further, we invite you to connect to the GAAP Advisors Ind AS Clinic podcast. That's available over on Spotify, Amazon, or YouTube if you're looking for a much deeper dive into the exact issue we dealt with in this explainer. As we wrap up today, I want to leave you with this somewhat provocative question. Are your year-end performance obligations accurately unbundled? It's really a question every single financial professional needs to be asking. Thank you so much for your time today. If you found this valuable, we'd really love it if you could like and add comments on this explainer, and please subscribe to the GAAP Advisors Ind AS Clinic channel if you haven't already. And finally, we kindly request you to share this explainer among your contacts, your colleagues, and your audit and finance teams. Let's spread this knowledge of Indian accounting standards together. We'll see you next time.